Good day, everybody. This is Jim Kinney for the weekly market update for the OptionProfessor.com. And this is for November the 16th, 2018. Just as a quick introduction, I'm a graduate of Boston College, and I've been in the investment business for decades. And today we are going to go over my views and my opinions on a wide variety of areas. Again, as I say each and every show, past performance is not necessarily indicative of future results. And option trading and short-term trading does involve substantial risk and is not right for everyone. So do consult with your clearing firm, your broker, and your financial advisor, and your good common sense to determine what, if anything, is right for your circumstances. Okay, all right, let's take a look at what's going on. We've had a pretty volatile period again this week. And again, just to give you a quick review on some of the things that I'd been looking at for a while. Again, when we went up to the 2,900 area on the S&P and things like Amazon were up at 2050, I did bring to your attention that basis the 200-day moving average, the markets were extremely overbought and the likelihood of a pullback was pretty high, and that's exactly what occurred. Strategies from the option side at that point that I discussed with you was the collar strategy, which is basically combining covered call writing with put buying, and it does bracket or give parameters to your equity. And during big declines like we've seen, offsets significant parts of risk. And obviously that tactic that I was suggesting you investigate was a very good tactic to be hitting on to a lot of these stocks. Look at NVIDIA today. There's been, pretty much all the high PE stocks and all the stocks that were way above their 200-day averages. Not only have they come back to the average, but they've gone through it quite a bit. Now, we are here now, so what's going on right now? Well, last week I said that we had support at the 2,600 area, obviously, and then underneath that, you've got the 52-week lows at 2,530 on the S&P. Let's put the S&P chart up there so I can give you a little overview on the index, okay? All right. Now, the index is now at 2726. You see, we went way down to 2,600 there. Let's move the screen up just a bit for you. And then we rallied real strong, right? Above 2,800, then bam, back underneath. Now, there was a gap. You see that gap, which I talked to you about last week? Right underneath 2,700. I thought for sure that that thing would come down and fill that gap, and that's exactly what it did yesterday. And as you can see, Thursday, as I bring to your attention, is sometimes reversal days. You did see a great reversal. So when this market was down at 2,670, what I was focusing on was the 2,400 puts on the S&P expiring December, regular expiration third Friday. They were going for 10 or better. And that basically is a bet that the S&P will not hit 2,400 in the next month or so. And based on the margin requirement, could bring in 20 or 30% on the initial margin. Obviously, that strategy is not right for everybody. And you could either do it on an uncovered naked basis where the risk is not limited, or you could turn it into some type of a spread. Either way, that strike price at 2,400 for the next month looks pretty reasonable to me. And of course, the premium at 10 or better looked awfully fat. So yesterday, that was the thing that I was focused on when I was watching the market. Now, we got a little bit of a comment out of the Fed chairman, vice chairman, that was saying that they are going to be data dependent and they're well aware that the global economy seemed to be slowing down. People are viewing that as some type of a statement that the Fed may be closer to stopping their hiking situation than others. I don't know if that's the fact, or else that was just meant to basically give people the idea that they are there watching things and they could moderate their behavior at any point. That's obviously comforting to people that are panicking, and so obviously that's helpful to the market, whether it comes to pass or not. Some of the things that were going on, like higher wages, higher, companies passing prices through, making the prices rising, and things like wage growth and unemployment being low, and the GDP was 3.5, even if it slowed down to 3 or 2.5, that's still decent growth. And again, consumer spending still has been pretty good. So the bottom line is all the things that made the Fed want to normalize interest rates are certainly have not gone away yet. So again, I'd be a little early to take the party hats out. You could get a rally in the bond market, which you have had in the last week, but that rally may not be sustainable if these numbers continue to come in strong. So as far as the S&P is concerned, again, my view is the most likely outcome for between now and the end of the year is the trading range forecast, which is 2,900, 2,600, and basically meandering between both levels, possibly ending the year around 2,850. That's just a guess, but the parameter situation of 2,900, 2,600 and vacillating between them is not, I think, a far-fetched prediction. All right, let's talk about the VIX. We are all looking at options quite a bit. So let's take a look at the VIX, and I'll give you my view on that. My view on the VIX is that 15 is an equilibrium. So if we get to 10, it's obviously very low. And if it gets to 20, it's a little on the elevated side. And when it's trading above 20, I think you're at a risk for a parabolic, or shall we say a real unwinding move to the downside. So when it's trading above 20, I view it as a red zone, shall we say, that a big drop could occur because it's already above the elevated level of 20. Right now it's trading at 1970, as you can see. And if we can trade between 15 and 20, I would say that the market has a very good chance of being fairly stable. So 15 to 20, I would view the market as somewhat stable. If you're looking at something above 20, you have to be very careful about a sharp drop. That's where the hedging strategies of collars and married puts would make some sense. Obviously, those who had puts on things like Applied Materials and NVIDIA from last week are happier than the people who are just taking in all the water today. If you have any questions on how the hedging tactics work, again, you can email me at optionprofessor@gmail.com, and I'll try to help you with your questions so you understand the use and the risk of the strategies. But, having hedging tactics out there and protecting your equity is not a stupid thing. Sometimes a hedging strategy may cost some money. Sometimes a hedging strategy, if you're doing the collar, could cost you some upside. Of course, that's the opportunity risk and the actual cost risk if you just do married puts. On the other hand, when the markets start unwinding, like they've done on Apple, like they've done on Amazon and across the board, these hedging tactics can keep your equity from dropping into the tank. So again, knowing how the tactics work is door number one, and door number two is obviously looking for the proper circumstances to implement the strategy. Now, again, if we can get under 15, and you can see 15's been a rough racket lately to get under, then I think a full-blown bullish market may occur. So, I wouldn't get my party hats on until we can get that VIX under 15. Otherwise, between here and 15, I would look for that trading range going on. And if for whatever reason we blow out this 23, 25 area, then we're going to probably be going into the soup. And that's why hedging, stop losses, and things like that, should definitely be part of your arsenal. Okay, so that's the story on the VIX right now, and it's pretty obvious where we are, as you can see. All right, now some other things that give me indicators on what might be going on with the overall market. I watch the transports, okay? So let's go take a look at the transports and see what's cooking there. Again, the transports and the Russell led us up when we had this move in the summertime, right? And into the fall. So they were the leaders, in my view, on the way up. They also told us that the market was rolling over. Can you see once we broke under 11.5 on the transports, it was kind of telling you that the market's rolling over. And obviously it rolled over big time. Now, where are you? You went under 10,000 on the transports, and now you're coming back to this 10.5 area. This 10.5 area, 10.6 area, I think is kind of important, because if we can get above it, and then I think you could go to 11,000 on the transports. If you go to 11,000 on the transports, then of course that would underscore the idea that we may have a rally at the year end. So I think if the transports can start going 10.6, 10.7, 10.8 up towards 11, then you got a pretty good shot that this market will go up as well. The Russell, of course, is the smaller caps, and they've been getting nailed big time. Again, they were one of our leaders, I think, in my view, on the way up. As you can see, bam, bam, bam to the upside. And then once we broke 1,700, people were yelling out timber because, as you can see, it fell off the table and pretty much accelerated to the downside. Then we had this big snapback rally up, which obviously probably had a lot to do with short covering. And of course, when you have order imbalances, that's where you get the volatility, right? I mean, if everybody's selling out of the Russell at 1700, 1650, et cetera, and there's no bid on the other side, you got an order imbalance. And anybody creating markets or taking the other side, if they see the volume is enormous coming in on one side, they're going to drop the bid, right? That's what they do. And they try to drop it as low as possible so they can get the best price. Then when they see the volume drying up, they obviously, can turn around because, the selling doesn't last forever and neither does buying. So again, when the selling dried up at around 1450, there was people who were short trying to get out. Now you got no sellers left, so boom, the guy on the other side of the trade raises his offer up towards 1600. He takes all the action in, and when there's no buying coming in because most of it might have been short covering, you fall off, and that's what's happened. Now again, the good news is that you made a low at 1450 and you made another low around 1500 ballpark, and now you're at 1516. Again, it would be nice to take out this rebound high. If you take out this rebound high, then a move towards 1650, which there should be some resistance there, might be in the cards. Again, if you take out 1450, then obviously we're back in the soup and back into possibly the abyss. But I don't see that in the cards as a high probability thing right now. Again, this also had the golden cross, death cross, whatever they call it, but that has a spotty history of being helpful or not helpful. I'll show you what they're talking about here, so when they say it, you don't feel like you have to go uh, to anything else. You're at 1607 on the 50-day average. You see it right there where my cursor is, 1607, and the 200 days at 1614. So you see where you could go back up towards 1600 if this thing could get on the bicycle for the end of the year rally, if it is going to have one. And then, of course, you can see also that it is dangerously underneath all the averages, but it looks a bit oversold. 1450 when you're 200 days at 1614. It's a direct opposite of what we had when I was telling people at 2900 and the S&P and 2050 on Amazon that you're way overbought and the thing's running out of air. Now, not only have you taken away the excess, but you've also gone through the other side to a little bit of an excess. And again, if they shake hands at the G20 meeting at the end of the month, I don't think you should be expecting them to get rid of the tariffs. But what they could do, and probably will do, is freeze the tariffs where they are as they continue to negotiate. I don't think either the US or China is in a position to jump these tariffs to 25%. I think 25% from 10 would be the silver bullet for this thing. And I don't think Trump or anybody else wants to shoot that bullet. So the bottom line here is, what's the most probable outcome in my view? Again, trading range with maybe a little bit of a higher close at the end of the year. That is probably also the best case scenario. Okay, so that gives you a little couple of things that I'm looking at that might be helpful for you as you're looking at the stock market. Let's go look around at a few different things like I usually do and see what's going on as far as individual stocks. You guys are all probably looking at NVIDIA. Again, NVIDIA was a poster child for everything I've been talking about. So if you've been listening to this broadcast, you know what I've been talking about. You're at 167. Look where the high was, 292. Let's go take a look at the 200-day average so I can explain to you why when it gets way away from the 200-day, you got to start looking for a turn. Okay, now, right now, this is today, but the high of 292 happened in October. So that's a month ago, right? Well, look where you were on the 200-day. You were down in the 50-day. You were down in the 230, 240 area, and you were 20% above the 200-day. Now, obviously, anything 20% or better is in the overdone category generally. So obviously, you've come through it. Not only did you come through it, though, you went through it like a knife through butter. And talk about the death cross. These two things are inverted, and that's not good. But now, look, you're at 167, and the thing is at 244. So is this the time to be panicking out? Well, some people are looking at 130, 140 for NVIDIA, but I would be looking for a chart formation, meaning a low surrounded by higher lows, so you have a point to defend. And then I would be looking for something that might snap it back a little bit. So again, if you're at 244 on the 200-day, you take away your 167, and you're going to have 77 points. On a percentage basis, you're now 31, 32% under your 200-day, and that's in the zone of what I would consider oversold. Doesn't mean it can't go more, particularly on a stock that has such a what do you call it? Such a volatile business, the semiconductors, and where the whole the whole situation is a little bit dodgy for the whole industry group. But at any rate, it is getting a bit oversold. Let's take a look at Applied Materials and um, and see what happened there, because I believe they came out and got nailed pretty good. These are the ones in the news from last night. Okay, materials, no, not too bad. It was down to 32. It's snapping back. Let's take a look at the 200-day average and see if there's a reason for it to snap back. It's going for half price. I mean, it went from 62 to 30. That's a pretty good discount, right? But again, this is something that's way under, way in problems here. So you are about 20% underneath. When you got to 32, you were 14 bucks underneath the 200-day. Again, that's getting a little bit on the oversold side, and so that's why again, you got to start looking for possible chart formations of which you could maybe take a speculative position. Maybe again, call options when the markets are in a tank is a limited risk way to play for a rebound. And again, when the markets tank like this, the call options probably get pretty skinny. And rather than going in and buying, 1,000 shares for 35 grand, if you thought there was going to be a bounce, you could investigate call buying. And then when you do your call buying by going to the option chain, look at the ones that are further out, because sometimes a 6-month option versus a 1-year option is not that much difference in price, and you get double the amount of time. When you're buying options, running out of time is a big factor, and the price, the Black-Scholes model on how time decay works is pretty much telling you that the nearby options will lose their time premium faster month to go as far as the time premium. Okay, let's take a look at another one here, which was J. Nordstrom. Okay, Nordstrom came out, and that was pretty messy after the close. And let's take a look at that. Now, their online sales were only up about 20%, so that's what got people freaked out. And boy, that's a messy one. See, this is why you got to know your hedging tactics. Again, use that email address at the end of the broadcast, and if you have questions, I'm more than happy to try to help you with them. I've been doing this for a long time, and I'm pretty familiar. Again, a lot of short interest in this stock. 12.3% of the stock is short. But again, we're at 51 bucks, and in November the thing was at 67. Now again, another classic example of what I've been trying to tell people about. If you're at 67, on November 6th, right, and the moving average is down at 53, you're 14 bucks above the average. And there you're at 20%. Again, 20% or higher is what I would consider in the red zone for being a bit overbought. Obviously, it varies from stock to stock. A stock like, that has a high multiple and a high flyer, that obviously, with a lot of beta, that obviously could have a different situation. But, I don't like anything 20, 30, 40% away from the 200-day average. That's I've been in this thing a long time, and I know, it doesn't happen all the time, but if the probabilities are unfavorable, I think you act accordingly. Okay, let's take a look at Apple, because that might be interesting here, as well as Home Depot and some of the other big guys that got nailed. Yeah, as you can see, the Apple goes from 223. And again, this is another classic case. While I was telling people up at 230, I don't care if everybody, including Buffett, is buying. And Buffett didn't buy at 233, as far as I can see from the reg filings. When you're at the 200-day average, 192. So again, what's say 190 versus 233? You're 43 bucks away, divided by your 233, and what do you get for a percentage there? You get 18.5%. That's close enough for me, and this is a big stock. So obviously, getting 20% or 30% above your 200-day average on a big stock like this is a big deal. So obviously, that's where you want to learn your hedging tactics. Right now, again, there was gaps and everything down. So what's the recent lows? I think let's go back to the chart here. I think the recent lows around the 180, 185 area. Yeah. So again, if we can hold that area, there's a gap right there. Let's go take a look at it. Right above 200 would not surprise me. And under certain circumstances, there's a gap right under there around 215. So if this thing got on the bicycle pretty good, now what's the problems here? Again, they don't want to tell us what the iPhone sales are. I heard that's 60% of their business. So obviously, it would be like if GM 60% of their business was in a certain vehicle, and they're not going to tell you what the sales are in that vehicle. That would make people a little uncomfortable. Their services side of the business is supposed to be picking up. I guess it better have, if in fact you're going to be looking at slower sales on the iPhone. I guess the new ones are not doing that great. And that's, of course, why the semis are also getting hit a little bit, because some of their suppliers are getting hit because they're saying things might not be so fast. But again, Apple does have a large war chest. And again, one other thing I'd like to mention that could be very bullish here. I have been hearing that there could be record buying of buybacks by corporations in the month of November. We're only at mid-month. So if these guys start going into their piggy banks, and some of them have huge piggy banks like Google and Apple to name two, and they start buying their own stock, this could also be a very good lift, because again, when you drop like that, you have exhausted some selling. And when it goes way down and the sellers are gone, and the buyback people come in, and the G20 meeting goes pretty good, and the Fed backs off their hawkish talk, that could be the recipe for a little bit of a bounce. I don't think we're going to take out 230. That's not on the table right now, but I do think a rebound rally is not off the table. Again, right now, that 185 area seems to be your line in the sand. Looks like 180 would be the real line in the sand if you look at those former highs, and then you look at that low right there. So 180 is really a nice possible line in the sand. But again, this is a big company that makes an awful lot of money, and as you go around the world, they love their phones, and so I wouldn't get too bearish on this thing right now. Okay. Let's I'll give you a few different ones. And what about Home Depot? That hit the 170 mark. That looked pretty cheap to me. Let's see what it looks like now. Yeah. Home Depot 175. I think it went down to like 170, and I think that 170 mark might be something of which it may defend. Again, you have very high volume sell-off. Sometimes that is an indication of a blow-off to the downside. It's still holding on for dear life here, so it's certainly not a definite. But if it can hold the 170 area, and maybe it has a little bit of a future. But again, there is some reports that the repairing your house, or what do they call that? Renovating your house. That market is drying up a little bit, and of course, that wouldn't be helpful to Home Depot. All right. What I've also told you about in the last few weeks, which I think is good, is keep an eye on your Chinese stocks. Okay. So let's take a look at some Chinese stocks here. The big one, of course, is Baba. Okay. Don't forget, these companies have been whacked and whacked pretty hard. So we're at 152 on Baba. We went to 130. Okay. And we've come down from 211. So, you're getting into a pretty, a big sell off that we've had. And I think that 130 may hold up for a while. Let me try to get it on the screen here a little bit better. You see the high volume sell off, high volume sell off. Okay. And now, again, that could be a little bit of exhaustion. So, you've got a little bit of head and shoulders trying to set up here. Let's take a look at the moving averages. This is very dependent upon how things go with the G20. And if it goes well at the G20, and the Chinese stocks seem to be turning a bit, this is one obviously that might participate. They had a big day with their Singles Day. And again, talking about overbought, we went down to 130, right? And where's the 200-day average? 177. So 177 minus your 130 is 47 bucks. Divided into your 177, and we were 26% underneath the 200-day average. Again, you're in the zone, and now you've got a line in the sand at 130. And then if pullbacks occur like today, you start looking at what might be able to give you a hand. Again, limited risk call options might be the better way to go. 1,000 shares of this stock would go for 150 grand. If it goes down to 130 or 120, 20 or 30 grand's a big hit. But if you put in, a smaller amount on limited risk options, give yourself 6 months to see it turn, that might not be the worst call in the world. If you think China is bottoming, if you think there'll be helpful conversations, if you don't, stay away from this stuff. Okay, Baidu. Baidu is at 184. Look at the low was 177. Okay, 270. Okay, so they have taken the air out of these things. Okay, if you wanted to sell, you're certainly not early, right? So if the selling is going to dry up and we are going to see a turn out of this 170 area. Let's take a look at where we are here. Okay, 7, that'd be about 60 bucks. There's your 20% or better oversold from the 200-day average. And that's why it's in the zone where you're looking for formations of which that would indicate a turn. And then you're looking for a point to defend against. Okay, let's take a look at another one here, which would be uh, 10 cent. Hang on one second here. Okay. Okay, 10 cents at 37, used to be at 60. Half price, hey, pretty good drop, right? And the low has been 31, so there's your low right around down, didn't take it out. Certainly not out of the woods yet, but sniffing around here in case you think there's a turn coming, is not the worst idea in the world. Again, I would try to quantify and limit my risk on it because, Lord knows how things will pan out. But again, where's your 200-day average? Your 200-day average is 47. You went down to about 30. So that's 17 bucks underneath your what? 200-day average. So you take your 17, you divide it by the 47 number, and there you go, 36% underneath the average. Again, you're trying to find something. If you think there's a turn, then I would say there's value down here in some of these things. Okay. All right. Let's quickly go through a few other things. The 10-year note interest rates. 10-year note, you're at 308. Okay, backing off a little bit because the stock market's backed off, because the Feds actually know that there's a slowdown in other areas of the world. And so, again, I think holding this 3% area is the key. 3%. As long as we're above 3%, I'd still be voting that rates will be higher down the road. If we start breaking under 3%, then you got to reassess. But right now, you're seeing a pullback in a bullish uptrend, in my view. And again, I think the economy's numbers are still going to remain fairly strong. And I don't think the Fed's going to hit a panic button. My view has been, as long as we're trading above 2,500 on the S&P, the Fed is going to normalize, providing the unemployment rates stay low, the wages and the prices continue to rise, and there is going to be a slew of supply coming on with the deficit going through the roof. So again, I still believe higher yields are in the cards, but if it got under 3%, I'd probably reassess my view. Okay, let's turn to the U.S. dollar, because that's pretty exciting. And that has had a huge run up again, and it went up towards the 97 area on the dollar index. You see the high is 97.63, and some people are saying it's peaked. And again, to our rate advantage, our obviously very favorable. So that is why people have been buying into the dollar. But if we start taking out 96 and 95, then I'll start buying into the camp that the dollar's making a turn down here. But right now, I see it in a bullish uptrend, having a bit of a pullback. I think telling everybody that the party's over, I don't think there's enough price evidence for you to say that. So again, under 96, under 95, I'll buy that there's a turn. And if you take out 94, then they may start yelling out timber, because obviously that would be a big takeout. So definitely the blooms come off the rose a little bit, but not enough to get on the bearish wagon just yet, as far as my view is concerned. But certainly, it could be turning because of obviously the supply of treasuries, deficits, and if we have a slowdown at all. Okay, look at gold. Again, gold's been trying to get a bid, and so some of the gold miners, have been somewhat interesting. And if we're going to have higher prices of consumers, higher prices of wages, then you're probably got a good shot of maybe gold benefiting from that. Somebody used to tell me gold bottoms when interest rates bottom, because if you think about it, they're hiking interest rates because of inflationary pressures. Inflationary pressures are kind of what gold likes to hear. And if the dollar were to really roll over, that would also be a positive on gold. So this is something that I brought it to your because I'm looking at that 17 on the GDX as a potential low. Now, if we can get above 20 and then 21, there should be some resistance at 21. Then the moving averages, let me give you the moving averages, might provide a tailwind. You got a 10% short interest, that's pretty high. So short covering could occur. But can you see the 50 days still under the 200 days? So you can't get the party hats out just yet. But again, we're trading above the 50-day. That's the first step. Get above the 200-day, stabilize there, get the 50 above the 200, and then 2019 could be very positive for gold. And again, call options going way out are probably dirt cheap. Might be a little early to get in, but certainly the start of a turn has occurred. Whether it's going to stick or not, time will tell. And then the one last thing is in the soybean area. And the soybean situation is that the demand out of China has frozen because of the tariffs. So look at this. You have in the agricultural sector called soybeans, but there does seem to be a little bit of a turn going on down here. That 825 area has gone down there and been tested a little bit, went back to 850. If we clear 925, going back to that $10 area is certainly not out of the cards. But really, a close above 9 would be the shot heard across the bow. So keep an eye on it because, again, if there's a good meeting on G20, Trump has been trying to help the farmers. And so obviously that could be a situation where that kind of movement, again, above the $9 mark and the 925 could light the fuse. Let's take a look at the moving averages, and then I'm going to leave you for the weekend. Let's go here, the 200-day and the 50-day. 869 is your 50-day. 943 is your 200-day. So those are messy looking averages, and that's why it's a little early. But the volume has definitely picked up. 63,000 shares averaging on a 50-day basis, 23,000 on a 200-day basis. So it's gone from a dead market to certainly the volume's increased, and the prices have increased a bit. Again, closes above 925 might get you going. And a good report out of the G20, a lot of shaking of hands, etc., might also be helpful. And one last thing is on the price of oil. I just wanted to get a little bit of an idea on that because that's been in the news. Definitely looks like a bit oversold. Let's see if we can get the crude oil contract up there, and then you can get an idea of whether some of these oil stocks like Chevron and Anadarko and those people might be worthwhile. Okay, we're down here from 75 bucks. Let's get the screen up there, and then I'll. There you go. We are above 75. Look at that. That's a dump, huh? All the way down to 55. And there's a low down there, so that's why it's kind of bouncing off the 55 number. I don't know if it's going to hold or not. Let's take a look at the moving averages and see how oversold we are. Here comes the moving averages, okay? And where are you? 62? Again, oh, there you go. Come on down. There you go. Oh, I'll be good with this cursor one day. Okay, 62.85, and you're at you went to as low as around 52, 53. So what are you, about 10 bucks underneath? $10. And again, look how overbought it was. You're at 76 with the moving average at 200. That was in October. When you get that far above the moving average, you got to look at your collars, you got to look at your put hedges or your speculative puts, because the likelihood that you're going to come back toward it, in my view, is pretty good. Now you're underneath it by about 10 bucks, which is, not 20%, but it's getting close. And again, this is a neighborhood between 50 and 55 that might be a neighborhood to take a look at the long side. At any rate, what I would like to do is I would like to invite you to give me an email if you have any questions on anything I talked about today. If you have friends or associates that are trading and you want to let them know about this podcast, please, get the link and give it to them. You need to just go to OptionProfessor.com, OptionProfessor.com, and you could go to the broadcast here each week. If you have a question for me or you want to speak to me, you can use the email optionprofessor@gmail.com, and I'll try to give you as much help as I can. Again, this is my views, my opinions only. And of course, there are many others out there, as you guys are well aware. Again, I would like to thank you for being here with me today. I'll be back with you next Friday. Until then, I'm Jim Kinney, and I wish, as always, all your trades work out well, and I wish you all do good with your trading. Okay, thanks a lot. We'll see you next Friday.